Well, good afternoon. Happy Friday, January 19th. Mark Milam here. Let's get right to what happened this holiday shortened week. Not the week we were really hoping for, unfortunately, due to some economic data that would suggest that we're seeing activity start to pick up a little bit. We're not seeing the slowing that we had hoped for or anticipated as we closed out 2023. Let me flip the screen around. I'll show you what happened with mortgage-backed securities over the last 4 business days. This is Tuesday the 16th when we came back from the holiday weekend. This is Wednesday, January 17th, a big sell-off in mortgage-backed securities. We saw interest rates increase and then rather flat over the most recent 2 days, thanks to really not a whole lot of economic data reporting. But let me show you why the market's reacting the way that it's reacting. We scroll down here to see the start of the week. We can see retail sales coming in hotter than expected at 0.6 against a consensus estimate of 0.4. Even when you strip out automobiles, still coming in a little bit hotter. Import prices up higher than anticipated as well. And then as we move throughout the week, you can see that initial jobless claims coming in lower than anticipated. Stop me if you've heard this one before. We're not going to be able to break the labor market, and it just keeps telling us, hey, listen, there are not enough workers for the number of available jobs. Initial jobless claims showing us that yet again yesterday. And then today, consumer sentiment coming in hotter than expectation, 78.8. All of this points to now the futures traders saying we're down from over 70% rate cut probability in our March meeting down to just 44.3% in terms of a probability of a Fed rate cut in March. So not great news overall, really not what we're looking for, and the market didn't respond positively. Depending upon note rate, you're anywhere from 1/8 to 1/4 to 3/8 worse in rate as we close out this week versus this time last week. But is there any teeth to this data, or is this just a blip? Is it not a straight line down? Because it's never a straight line up, it's never a straight line down as it pertains to economic data. And really, the overall trend would suggest that maybe it is just a blip. Let's be clear. What we really care about here is putting inflation back towards 2%. All of the noise about jobless claims, all of the noise about consumer sentiment, all of that is just ancillary when we start talking about what really matters here. It's the consumer price index, it's personal consumption expenditures getting back towards the Fed's target rate of 2%. Once inflation's back in the bottle, the Fed can begin cutting the Fed funds rate, and that's when we'll start to see all of this affordability improve. So let's look at some data that's brought to us by our good friends over at ArchMI. And when we talk about housing as a component for inflation, this green box here, you can see that housing is a bit of a laggard when it comes to its impact on inflation. We see that housing is on the downtrend, and it will continue to be on the downtrend, and it's a massive part of the overall inflation number. And really, when you're talking about housing here, what we're talking about is not the price of buying a house. We're talking about monthly rents. That's what we're measuring as a percentage of inflation is monthly rents, not necessarily purchase price of houses. So what's been happening with monthly rents? Well, let's just slide to the right here and take a look. The writing is kind of on the wall here, and these dashed lines are the owner's equivalent rent and the CPI rent here, and you can see that they're trending down, but have a ways to go. And if we follow the prediction or the prognostication of the Zillow index, which is already up to present day, you can see if we just follow this trend line down, housing is going to continue to decline, and it will start to pull down the overall inflation number. And again, we're talking about rents here, not the price of homes. We know the price of homes is going to continue to go up just because of the absence of supply. But when we talk about monthly rents, we anticipate that to continue to go down. So that lends a little bit more credence to the fact that the economy isn't in fact picking up steam, but that this is a blip on the way down, right? It is never a straight line up when rates are increasing. It is never a straight line down when rates are decreasing. So hopefully this trend will continue, because the ultimate goal, if you strip out all the noise around all these different economic data points, is to get inflation back down to the Fed's target rate of 2%. Once that job is done, the Fed can say mission accomplished, take their foot off the gas with the Fed funds rate, and we can begin to see a decline in that rate, and then an associated decline in every other rate that's indirectly impacted by the Fed funds rate. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.